Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Well, going back to what we've talked about in the past with the yield curve, I wanted to bring you back up to date a little bit on where the current rates are. The yield curve inverted again over this past week and actually stays inverted or has stayed inverted. But an interesting thing was I heard a longtime market pundit on one of the financial networks today, and remember when we talked about this before, when somebody says, well, it's different this time, beware, because usually it's not different. If you're trying to say that something that is philosophy or some sort of an event that has stood the test of time is all of a sudden as different this time, usually it's not. Quite often it's not. So you kind of have to take that with a grain of salt. But the viewpoint was that, well, normally when the yield curve inverts, and we're talking about the 3-month and the 10-year, which is the most important one that people watch, is that the 3-month actually goes up and crosses above the 10-year. In this case, as you can see from the chart that I have on the screen, the 10-year has crossed below the 3-month. So instead of the 3 turning around and going up, all the rates are actually going down. You can clearly see that on the right corner of the chart, but it's the 10-year that has dropped below the 3-month, and that in some cases is viewed to be even more of a sign of economic weakness ahead down the road. Again, we're not talking about next week. We're talking about 9 to 12 months down the road on this inversion, at least on its historical predictive powers. So it's interesting that it would be used from this pundit to say it's different this time, when a lot of people think it's not different, it's even worse. So we'll see how things play out over time, but I just thought I'd give you a quick update on that. The rest of the time we're going to look at the charts because there's some amazing Elliott Wave patterns in the charts and detailed patterns where you start to get into waves within waves. We like to talk about that a lot. So let's take a look at the charts. All right, taking a look at the SPY, we have the main Elliott Wave pattern on. You can see the wave 4 is corrected down to the 33% level. We're getting very close to that first big Fibonacci level that I like to look at, which is 38.2. So maybe a little bit more downside before we hit that. That could possibly create a little bit of support. Now, what's interesting is at the time of this recording, President Trump has already tweeted out that he's going to impose 5% tariffs on Mexico starting June 10th, and they're going to steadily increase until Mexico makes a concerted effort to stop the illegal immigration crossing the border. Now, there's a lot of people that are upset about that, saying, well, it's one thing to go with the trade war and the tariffs with China because that's dealing with trade. This is dealing more like social issues, and using the tariff power is a little bit of an abuse by some people. That's not what it was designed for. But nonetheless, that's what happened tonight, and the futures are down significantly. The E-mini futures are down about 20 handles, so we could very well hit that 38.2% or lower tomorrow if that holds. Anything could change between now and when the market opens. President Trump could tweet again, or who knows what could happen. But Mexico's response was kind of like, calm down, let's talk about this. But they didn't come out with an immediate, we'll work on it. There was more like, let's talk and communicate rather than ruling with an iron fist. But we'll see how it all plays out. But it's quite interesting anyway. So here we are with this current zigzag pattern, which I think you can clearly see in the wave 4. It's about as classic as it gets. So there's your impulse wave down in the A wave. And if we look at the correction, look at that, right at the 61.8% level, my favorite level for a wave B corrective move. So right on the 61.8% level. So then we go for the 100% extension, and that would move the SPY down to around 273, as you can see on the chart there. Now, we're at 33%. You come on down there, it's going to be pretty close to 38.2, isn't it? So we're going to be right at that 38.2% fib level, right at an 100% C wave extension on the zigzag. That could be a good point of support for a potential bounce. Doesn't necessarily mean we're going to go back to the upside just yet. We could still correct 50 or even 61.8% and still be well within the rules of this Elliott Wave longer term pattern to the upside. So there's your zigzag highlighted right there with the A, B, and C. I'll go ahead and label these this time, but there's other ones that I want to show you as well, and I don't want to take enough time to, or take the time to go through and label them all, just because this is going to be a rather long recording. So there's our ABC here in the SPY, and we'll see how far that goes down, and we'll see what happens when the market opens on Friday. Looking at the VIX, not a whole lot going on there. Little bit of a triangle maybe forming here, but you could have looked there, but you would have to bring your lines up and be something like that. It's a bit crude, not really a great looking triangle, but a quasi triangle nonetheless. Maybe it does yield a breakout. Maybe we get it tomorrow if the futures stay to the downside the way they are right now. It could be a low, a move down in the market tomorrow with a spike to the upside in the VIX. Well, let's look at interest rates. We've talked about that. For the importance of interest rates, you've got to keep an eye on the bond market. Even if you're an equities trader, you've got to keep an eye on the bond market. It's just crucial. Too much money in the bond market to ignore it. And the first thing that you should clearly see is this beautiful zigzag pattern right here to the downside in rates. And it is amazing how low rates are going. It's not a real positive thing economically when rates go down this low. It's just not. I know that economies in some aspects like it for the short term, but over the long term, it's not necessarily a great sign economically down the road. It's another predictor, kind of like the yield curve inversion type thing. But there's our big ABC zigzag pattern. So let's take a look at this one. There's the correction. This one, the B wave corrected right to 50%. That has the same rules as a 61.8% correction, in that we look for the 100% extension level. So let's look for where the 100% extension level would take us. And that's not much lower than where we are here. Now that could be a different sign, that if interest rates come down and they bottom a bit, well, maybe then we could have a little bit more of a bounce. It would almost be too perfect if the market came down to the 38.2% level, the 100% extension on that C wave of the zigzag pattern, and interest rates came down and hit 100% level of support. We could have the makings for a decent market bounce. But again, it's almost like that's too pretty, too perfect. The market doesn't always cooperate quite that nicely. So we'll see how far that wave 4 correction ends up being. Again, it could still go down to 50 or 61.8. It doesn't necessarily mean it's going to stop at the 38.2% level, but we may open there tomorrow. But another thing I wanted to show you is if I take the larger zigzag pattern off here, is if we start to break this down, it gets quite interesting. So I'm going to move this line over, the A wave, and you can see that we had a complex A wave. And it's complex because there was a little triangle right there. And what do you get from a triangle? You get a breakout. Boom. Big move to the downside. There's your impulse move, your explosive move out of the triangle. And that's what usually happens when you get a triangle. It'd be nice if all of them broke that far that fast. But it's a perfect example of a triangle and the breakout impulse move there. So complex wave A, and then if we move this B wave out of the way, look at that. We've got a complex B there as well, this time zigzag. So our corrective level is right to 38.2. Had a doji there right on the 38.2% level. So then we take that for the extension. And 61.8 was the level. It tried to move higher, couldn't. So right to that extension, and that was it. And then we had the downward start of the C wave. So there is your amazing Elliott Wave pattern on interest rates. And we've talked about the fact that the bond market has so much money in it. Remember, Elliott Wave, the more liquid the issue that you're looking at, the more accurate it tends to be. Liquidity matters. And so the bond market has all this money in it, so it works extremely well as far as Elliott Wave. Pretty amazing. So if we were to go to label this, we go ahead and write this in as a complex A. Move that right over there. We also had a complex B because we had that zigzag in there. And there's your zigzag right there. And I usually label those with smaller letters. So if you wanted to do that, the chart starts to get a little bit busy when you do that, but it's accurate. So it's up to you if you want to follow along with that or not. So there's A, B, and C with the smaller letters. And then very likely, if we have a complex A and a complex B, we're going to have a mono wave C, which we did. And that means just basically that the C wave was pretty much straight down. So then we would come over here and say mono C, and it should conclude a little bit lower there, 83% down to the 100% extension level. And again, we'll see if that Goldilocks scenario plays out where interest rates stop falling. We get a little bit of level of support there. The market hits a support level of its wave 4 correction, and everything bounces. We'll see, but it's quite interesting anyway, and pretty amazing the patterns that we have in the market right now. If you're not looking at Elliott Wave, you're making a big mistake, in my opinion. Thanks for your attention. Look forward to talking to you again next week. Take care, everybody.